you are guilty till proven innocent. So again,
Man.
yeah,
Man,
you can take it to court, but it's going to be very expensive to negotiate, right? So you keep that in mind.
It's not like a ticket where you hope the cop doesn't show up and then
So
the
they
case
exactly
gets
get off
dropped.
on it,
I mean,
yeah.
these
Right.
guys,
They're going to be
showing
there.
up.
If they show up at your door, yeah, they're gonna, I want to, caveat that, like, there are different levels.
This is the Pitches and Niches podcast. Connecting ideas with opportunity. How's your idea? This is the Pitches and Niches podcast.
Today, we got the tax man with us, Devin Sunderwirth,
Thank you.
and he's going to teach. Listen, this is going to be an episode where I like to use my wife as an example. Sometimes she would hate this episode because taxes, I'm sorry, but can be boring, right, Devin?
Absolutely.
For most people. For me, I think it's super interesting. So, Devin, thank you so much for coming on the show. I don't think
thank
it's
you for
boring.
having us.
I think what you're doing. Listen, it takes someone with a lot of intelligence to do what you do, and we're gonna get into it today. So, how can we help? I guess the premise of what we're going to talk about today is how can we help business owners, entrepreneurs, not have to pay the government.
Exactly.
You know what I'm saying? Like,
Legally. No.
legally.
Right. No, I think, taxes are boring until you have to pay that first tax bill
That's
as an
right.
entrepreneur when you start making money. Right. So, when you have to, take all your stuff to the tax person, H&R Block or whoever it is, and they give you, here's what you owe, all of a sudden taxes become real interesting. And then that's when you start going, hey, how can I be strategic? Right. The government has, the law has basically, Judge Learned Hand basically said, hey, listen, there's no crime in trying to reduce your tax bill legally, right? And pay the least amount of taxes you legally can, right? That's tax avoidance. Tax evasion is when you go outside the law to avoid paying taxes.
You just don't pay them at all.
Right.
Yep.
Yeah, exactly. That's the illegal part. That's what'll get you in jail or get your jet ski impounded and stuff like that. So, my goal is let's get your tax bill down as legally as much as we can. And, because nobody wants to pay Uncle Sam more than he's due.
Mm.
Nobody wants to pay Uncle Sam more than he's due, especially when you have businesses like the Quality Leering Center, right? Like,
I was just about to say that. That's where our money's going.
right? Like that's where we don't have to get into politics, but I mean, look at the climate of the U.S. right now. We see a lot of fraud that's going on. Are you starting to see more and more business owners come to you and go, I don't feel like paying. I mean, look at what's happening. Like, it feels wrong for all of us who've never broken the law before
Mhm.
to have to continue to pay all these taxes.
Well, I've had clients come to me like that. And I mean, sure, you hear that. You go, well, what are the chances of me getting caught? And, depending on how well funded the IRS is, it can be, maybe you don't get caught. I mean, there are a lot of people evading taxes that don't get caught. There are a lot of people evading taxes that do. And the
Yes.
IRS, there is no statute of limitations.
Yep.
So an administration can change, budgets can change. The IRS can go back a long way if there's fraud involved. Now, if you make a simple mistake, generally it's 3 years that they'll go back and look at a return. So if it's an honest mistake and you end up owing the IRS a little bit more, typically they'll go back 3 years and say, hey, you messed up and this is what you owe us. But if they find that you're actively evading taxes, they can go back forever. And then once they pull on that thread, they'll get you for everything.
Mm.
The tax law is so complicated that it's, I'd be shocked if any one person in this country was 100% tax compliant all of the time, right?
Mm.
So what we want to avoid is that position where, hey, all they need to do is start looking at you. They're going to find something to make your life miserable, right? So
Right.
let's not raise the red flags. Let's try to be as compliant as possible and strategic as possible so that we can lower that tax bill, pay as, the least amount legally that we're legally obligated and sleep well at night, right? There are people all over this country that are evading taxes, and they know they're going to get caught eventually. It's just a matter of when. And so they might be enjoying life, but I know personally, I don't, enjoy life if I think I'm going to eventually go to jail,
No.
right? Or that I could get caught, or I could lose everything because, I've just decided I didn't want to pay that 30% that I felt like, was unfair to pay. I will kind of go outside. I would love to not pay any taxes. I would be fine not having a job in taxes if taxes did not exist. But unfortunately, the rules right now that we live in this society forces us to do it, or we go to jail, or we get all of our toys taken away.
Yeah.
Right? So again, let's try to be as compliant as possible while reducing that tax bill.
Which is crazy to me because I'm pretty sure that what started the whole, Revolutionary War and fighting the British, no taxation without representation, right? And I think it was over a 3% tax increase over,
oh my gosh,
over tea, right? Like,
I love my tea. I'd be mad too.
Yeah. And so now we're getting taxed, I'm in, 25th or 27th percentile in tax and all that, so.
And that's the income tax. That's the income tax. That's something I'd really like to, if I leave your audience with anything today, I'd like them to understand the difference between income tax and self-employment tax, also known as payroll tax.
Yes.
So that's something I'd like to talk about, because a lot of people say, I'm in the 24% tax bracket. That's where most, I would say, middle-class entrepreneurs land, is about 20. If you're married especially, that 24% tax bracket hits most of that middle-class band. So people say, oh, I'm in the middle, I'm in that 24% tax bracket. So that means most of my money is going to get taxed at 24%. And that's simply wrong. No matter what, you're going to have some sort of Social Security or Medicare or net investment income tax tacked onto that. And so it's actually much higher than what you think your marginal tax rate is. Now, the tax code is progressive, or the tax rates are progressive. So if you're in the 24% tax bracket, that doesn't mean you pay 24% of income tax on all of your taxes or all of your income, right? The first tranche of income is taxed at like 10%, and then it slowly rises from there, right? So what I like to talk about is, let's say, it's easy for all of our illustrations that we talk about today. Let's assume that one spouse is an entrepreneur and one spouse is working a regular job. And let's assume, just to keep it really simple, right, that spouse who's working a W-2 job is eating up all of those lower tax brackets, right? So you, as an entrepreneur, are coming in, every dollar you make is going to get taxed at that marginal tax rate of like 24% or higher, right? So because if you're just single and you're just an entrepreneur, yes, a lot of your income is going to get taxed at those lower tax brackets until you get to 24%. But it's a lot easier when we talk about taxes to have a general idea of what that dollar is going to be taxed at, right? So does that make sense? Is everybody?
Yeah, it does. I want to say one thing before we really dive deep into this.
Sure.
Devin has saved my butt so many times. I owe this man my life because I bug him all the time about LLC, S-Corp, do we need to pay taxes on this? If you need a CPA, this is the guy. Like, for real. This is the guy. He's so busy though right now, he can't take on any more clients.
Right. Yeah, for 2025 tax season, which was last year. No, I can't take on any more clients for 2025. But if you have questions or are looking for something going into for the 2026 year, the year we're in now, I'd be happy to talk to you after tax season.
After tax season, which we're almost through. And I've gotten about 95% of all my tax documents in.
Fantastic.
So
I did see those come through.
And I will say it's one of the most relieving, like I feel relieved because I feel like I've accomplished a really big leap. Like a really big not a honey-do list, but a check-off list,
That's a big one.
Having your bookkeeping done as an entrepreneur is massive, right? And so those first few years, you're kind of getting organized. You don't really want to pay for a good bookkeeping software or a good bookkeeper. And so I see a lot of those first few years, they're going to get filed with extensions and it gets pushed into the later year, and you have that stress of like, oh my goodness, what are my taxes going to be? Because it just takes forever. You're also working your business, so we're waiting for your books, but they're just not done yet. So when you get to a point where you've got that kind of, the train is moving, you've got that momentum, and you kind of have that organization built in where your books are either being done by someone else or it's pretty automated, which you can do a lot of bookkeeping automated through
That's his
QuickBooks
favorite
Online.
word, man. Automation.
Automation, yeah.
It's not perfect yet, but you can do a lot of, set up rules-based, rules-based accounting where it can identify, hey, if this is gas at a gas station, it's going to suggest it goes to fuel cost or something like that, right?
Yeah.
If you're paying a power bill, it's going to see FPL. You can say, hey, if it's FPL, it's going to be a utility, right? So that can streamline your bookkeeping quite a lot. If you don't have a lot of transactions, I mean, sure, you can still keep it in Excel as you're starting out, but don't let, make sure you do it monthly. Don't wait till the end of the year while you're still working on your job, but then all of a sudden, or working on your business, and then all of a sudden I have 12 months of transactions I need to organize. That's going to either be very expensive if you give it to your accountant, or very time consuming if you try to do it yourself.
Yeah.
So
let's go into LLCs, and then I'm going to move into the S-Corp because I know you wanted to talk about S-Corp, right?
Yeah. And so the main gist of the S-Corp really flows from knowing the difference between income tax and payroll tax. And so if we can establish that concept first, I think will help your audience, understand why the S corporation is such a powerful potential tax saving tool.
Yeah.
So let's ask you this. Number one, when do you know when you need to convert to an S corp? Because okay, let me ask you this question first,
right,
and then we'll go into the S corp.
Yeah.
Most entrepreneurs think that forming an LLC solves their tax problems.
Right.
It doesn't.
No. So first of all, as far as the IRS is concerned, an LLC is meaningless. The IRS does not recognize an LLC as its own thing on its merits, right? And now it does recognize what an LLC is, but an LLC is a state level of organization, right?
Yeah.
So every state manages their own LLC type of wrapper. So as far as the IRS is concerned, it's not that you have an LLC. The IRS is only concerned how you want that LLC taxed, okay? And there's four main ways that you can tax an LLC. And this is how they're going to categorize your LLC. If you go and you create an LLC yourself and you don't have any partners, you don't put your spouse on there, you don't put a business partner, it's just your LLC in your name alone, and you don't make any other elections to the IRS, you default to what's called a disregarded entity, meaning that is going to be treated as if you had no LLC to begin with. You are just going to be treated like you're an entrepreneur that pays on their normal individual income tax return. On an individual income tax return, when you're a sole proprietor, you're the only person in the business, you do everything yourself, you're self-employed, or a contractor, like you get your 1099 NECs, right? That flows through what's called Schedule C on your 1040, right? Anybody who's done TurboTax, that's, all of a sudden, as soon as you have that 1099 NEC, you're putting in, all of a sudden TurboTax goes, yes, because now I'm going to charge you $250 to do this tax return, right? You're self-employed. You want to upgrade to the self-employed portion, right? When they upgrade you to that self-employed portion, they are opening the Schedule C on that 1040. And that's where the income from a contractor job or that 1099 NEC flows through. Now, anybody can be self-employed. Accountants, you could be a small manufacturer. I mean, if it's just you and you never elect to be taxed differently, it's just going to be your sole proprietor in the eyes of the IRS. And that is probably the least tax efficient way to be an entrepreneur, right? Because all of that income that you make by default is going to be subject to self-employment taxes, right? And so even if you have employees, which you can as a sole proprietor, it's not most people don't. Usually if you bring up employees, you organize yourself in a different way. But even if you have employees, you are 100% of your income is still subject to self-employment tax or payroll tax over and above what you've paid your employees. So that's really important distinction to know. The LLC doesn't really mean anything until you make an election. So let's say what are the elections are. So if it's just you and you're a one-man show, sole proprietor, disregarded entity. So the LLC, you just put the EIN on there and you're good to go. The second way is, let's say you form an LLC with a partner. It could be a spouse, it could be your kids, it could be
your dog.
Cannot be your dog.
Can't be an animal.
Cannot be an animal. No.
But you can leave. Can you put look? I've seen rich people.
I think there wasn't the richest cat in the world, like a 70s movie where a guy left all of his money to his cat. Yeah. And then I think there was,
it's not real, folks.
Famous comedian tried to kill the cat the whole time. I think the cat talked to. I remember it vaguely as well.
Yeah. So if cats can talk, they can.
I think we have a real interesting existential question. If a cat starts talking.
Yeah.
But let's say you form...
Some would beg to differ.
Let's say you form a partnership with another entity, a legal entity. I believe, at that point, two people in an LLC, owning an LLC, whether it be 1%, 99%, 50-50, if there's two people that have ownership, two or more people that have ownership in that LLC, and they do not make an election to the IRS, that is going to by default become a partnership tax return. And you are then taxed as a partnership. Now, partnership is taxed a little bit differently from a Schedule C, but you are still, in most cases with a partnership, if you're an active partner, and I want to make that distinction because everything I say almost has a caveat in the tax law, right? And so we could spend days going over all of the little carve-outs. But let's just, for general purposes, if you're an active entrepreneur and you're actively working in the business and you're in a partnership, that partnership income is going to be subject to self-employment tax, right? And this is what I want to emphasize the difference. So remember, we were talking about your income tax and it being around 24%.
Yeah.
Let's just, for sake of example, it's 24%. Self-employment tax is right around an additional 15%.
Wow.
Right. Yeah. Yeah. So what are we looking at? Not 39% is really what you're paying taxes on?
It's the government trying to keep the little man down. That's exactly what they're trying to do.
So the concept of it, on the face of it, sort of makes sense because it's basically what it is Social Security, Medicare.
Yeah.
Right? When, everybody who's had a W-2 job goes, where did my paycheck go when they see their first paycheck? And it's usually not with federal income tax withholding. It's usually the FICA. It's Social Security and Medicare. And what people don't understand is they're paying about 7.5%. Again, before someone writes in and goes, actually, the number is, I'm just going to say, just to keep it simple, about 7.5% between those two Social Security and Medicare numbers is roughly 7.5%. That's what you're paying on your wages. Okay. But what people don't understand when you're an employee,
which I know it well because we've been over this now.
Yes, exactly.
Pay it every
right. But you have employees, right? So what you realize, but when people who are starting their own business don't realize is that while they're paying roughly 7.5% to the government for Social Security and Medicare, their employer is actually kicking in and matching that. They're paying in 7.5%. So let's say an employer, let's say you give you hire
monthly.
Yeah. Oh yeah. No, I mean
monthly.
It's actually going to be every paycheck. I mean, some people have to pay it weekly or semi-weekly.
Yeah.
But let's assume you hire somebody for $100,000, just for a nice round number, $100,000, right? They see $100,000 for their salary, but what it actually costs you as the employer is $107,500 because you're paying them, and then you're paying half of their Social Security and Medicare. But nobody, you don't say, "Oh, my salary is $100,705
Yeah.
Right? They don't think of it that way. They think, "Oh, I make $100,000, and then I have to pay, the income tax part of it, and then I have to pay Social Security and Medicare, but they're only paying half.
Yeah.
And so when you're self-employed, you are your own employer. You're paying both sides of that equation. Okay, so when you do that Schedule C, you make $100,000 on Schedule C, you're not paying, or you're not netting basically that 7.5%. You're paying the full 15.
Yeah.
Now there's a caveat. I'm going to put this out here real quick. You do get to deduct from your income, like your income tax, half of that self-employment tax. So it does bring that 15% down a little bit in actual taxes you have to pay. But again, for the sake of just kind of getting the concepts, let's just table that part there. But I don't want anybody to think, well, you get to deduct half of it. Yes, you do, but it doesn't make a big impact because you really are paying that 15%, and then you get to turn around and deduct 7.5% for income tax purposes. Again, if your listeners can walk away with anything, it's knowing the distinction between income tax. That's what funds the military. That's all of the stuff that we pay the federal government for. And then there's Social Security and Medicare, basically, right? And that's that 15% if you're self-employed, right? So how do we stop that? Because legally, depending on what entities we create, right, we can avoid paying that self-employment tax on all of our entrepreneurial income, right? And that's where the S corporation comes in handy. So before we get into the S corp, I just want to rattle off the last two.
Yeah, because there's four.
There's four, right?
So the first two, name it off first.
Disregarded entity.
Disregarded entity,
also known as sole proprietorship, right?
Okay.
Number two, partnership. You don't have to make an election if there's one or more people are gathered together.
Yeah,
it's a partnership, and then you've got to file a 1065, and if you don't, you get penalized for not filing that, right? But that in most cases, as active entrepreneurs, you're going to be taxed on all of that income, partnership income. Self-employment tax will be subject to self-employment tax. So then there's the other election. There's the S corporation and a C corporation. Okay, most small businesses are probably going to go towards the S corp, but there is a very, very lucrative reason to maybe file as an C corp. And we can get into that in future episodes.
Very interesting.
Yeah, we can get into future episodes about that, but I kind of want to table that. But I just want to say there is a real reason that some people do organize as a C corporation. But for most people starting out, they're going to default towards wanting to pay less in self-employment tax and organize themselves as an S corp. From you can organize yourself as an S corp as a sole proprietor. So you can go from sole proprietorship into an S corp, and you can go from a partnership into an S corp. Okay, and you could also do that.
Once you're an S corp.
Once you're an S corp, you have to basically revoke.
Go back.
No, you can't.
No turning back now.
Yeah, you can, but it's a pain. I wouldn't recommend it. I've never seen someone do that. I've seen people go from C corps to S corps, right? And I think there's been situations where I think, especially after in 2012, a lot of S corps went to C corps because the corporate tax rate went down so much. So there was some conversions there.
What does it stand for? Tell everybody what it stands for. C corp and S corp.
Subchapter S is the S corp, and and then C corporation. Honestly, I don't have the answer for that.
I don't think anybody knows. Nobody knows.
There an answer.
I'll be honest with you, Devin. Most of the things that you're telling, it's like you're speaking Spanish to me.
Right. I'm trying to, but no, I wish I knew the answer. The answer should be, ChatGPT, I'm sure knows, but
sure.
But I believe the S in the S corp goes to subchapter S of the tax code. That kind of breaks out what an S corp can be. And if I'm wrong, I really apologize on that. But let's talk about the S corp.
Yeah, you're right. Subchapter the name C corp is the name comes from a subchapter C.
Okay, there you go.
So you have a
subchapter S.
Thanks,
subchapter S and subchapter C.
I appreciate it, man.
So
Yep,
there you go.
All right, fantastic. The concept of an S corp though is this, right? When you invest in, let's say you invest in Coca-Cola, right? that's a C corporation, I believe. Yeah. Publicly traded, right?
Right.
You're not active in that. You're not bottling any Coca-Cola for them. If you did and they paid you, you'd
You're
be
just
subject.
an investor.
Yeah, you're just an investor. So you've given them money, right? And then their employees, you're not the employee, but their employees have bottled the soda and then they've sold it. They've distributed it and they sold it and they've made a profit. And then you get paid a dividend, right? Or let's say they give you a dividend or your stock price goes up because they've kept it in the system, right? Kept it in their company. And so it's worth more because they've kept the profits. And so when you sell that stock or you get a dividend, you are not subject to self-employment tax on that because you're not employed by them and you're not doing any work for them, non-employee compensation for them, right? You invested. Similar to you put money in the bank and you get interest. They haven't been paying a lot, but you get interest on a CD.
Made $2 last year off of my checking account.
Exactly.
So
That $2 is what the IRS considers unearned income. Now that seems like a loaded term. Yeah, I mean, I feel like if you saved it and you earned it. No, but from the term for the IRS, what they look at that is they call that unearned income, and when it's unearned income, it's not subject to self-employment tax. A really important distinction.
Unless you cash it out of, like your let's say your Coca-Cola stock.
Yeah,
you reinvest the dividends. If not, when you take them out, you're subject to taxation.
No, you're subject to income tax.
Income tax.
You're not subject to self-employment.
Self-employment. Yeah.
Right.
Yeah.
So when you have that, when you understand that concept, the S-Corp starts to make a little bit more sense because when you have an S-Corp, let's say you have other employees, other people are working, right? There is going to be a part of your investment into that company that is going to have a return similar to your investment in a publicly traded company, right? That is not by your hand. That is not because you earned it by working as an employee. Now, you are still an employee of the S-Corp, but a portion of that profit is going to be subject to payroll tax.
So at the end of the year, after, let's say, you've worked, let's say your company makes $1 million gross a year, right? You've invested a lot of money into that.
Exactly.
These guys are earning you money at the end of the year once taxes are paid and there's a surplus left over. That's when you would divide out. That's non-taxable income.
That's not
income. No income.
It's
no
income.
Self-employment tax.
That it's still income taxable.
But it's no self-employment tax on that. So instead of paying the 35%, you're going to be taxed on the 24%.
Exactly.
Right.
Exactly.
Okay.
So it's just the 25%.
Gosh. I've been trying to get to the bottom of this for like 5 years with you, Devin, and now you're finally starting to make sense to me, man.
Right. When you understand the basic concept of the payroll tax versus the which is again, payroll tax and self-employment tax are pretty much the same thing, right? Yeah. When you get that and understand the distinction between that and the income tax, then the S-Corp all of a sudden starts to make more sense because what the IRS wants to see if you're working for the S-Corp, right? They want to make sure that you take a reasonable salary, which would be like, let's say, you invest in this S-Corp and you're an officer, they'd want to see you get an officer's salary for that size of a company, whether that be $100,000. Like, a lot of CFOs probably can get paid around, for a small business, get paid around $100,000. So if you pay yourself $100,000 and you make $1 million let's say the income from the S-Corp after you've paid yourself and all of your employees is $1 million, only that $100,000 you paid yourself as a W-2 employee is subject to the payroll tax. And then the $1 million that flows through to you is going to be subject to income tax, but not subject to self-employment tax because of the concept of, hey, part of you is an employee, yes, but part of you is an investor, right? And that part should not be subject to self-employment tax because that part should be considered unearned income.
An investor where all your money's going, an employee where I'm getting nothing in return, to be honest. Like when you're first starting out, like you're paying the business so you can work in it for free.
Right.
Yep.
Let me ask you this. You talked about reasonable salary. The concept of a reasonable salary confuses almost every business owner. Like how should entrepreneurs think about a reasonable salary, especially starting out?
Yeah. So that's a very gray area. Now you can hire firms. They'll give you like, here's what a reasonable salary be for, in your area. You can get really granular, right? But if you're not making money, like the first couple of years you're doing a startup business, I have not generally seen, the tax law says you got to pay yourself a reasonable salary. I have not seen the IRS aggressively pursue S-Corps that are losing money those first few years that are not paying a salary to the owner. Okay. I believe the law allows them to, and allows them to force any S-Corp to pay a reasonable. So if they come in, they say, hey, listen, you've been putting 40 hours a week into this business. You need to pay yourself at least, let's say $20 an hour. And now that's subject to self-employment. You could really, that means you're paying taxes on money on a losing position. Again, I think they understand that, and that's what they're not going to go after. So if you make like $100 at the end of the day and you don't pay yourself a salary, you're probably not going to be audited. You're probably not going to get slapped on the wrist. And there's a famous case where an accountant created an S-Corp for himself and paid himself a zero salary and took it to court and lost real bad. So not every
Could it be labeled as a hobby after a certain amount of time?
Hobby is subject to self-employment tax.
Really?
Yeah. So, yeah,
they're coming to get you.
They're
coming to get you.
The hobby is bad for you in the sense that you can't write off your losses, right? So you got to be careful with that. The hobby is a bad word for anybody, everybody, us all around, right?
Yeah.
Again, if your first couple years as an S-Corp, you're not making a lot of money. And usually that happens if you've converted to an S-Corp a little too early, right? So
point his finger at me.
Yeah, exactly. No, you actually did it right. But I'm just saying, like, a lot of people will jump to, I'm going to turn this into an S-Corp, and all of a sudden they got to file an 1120S, and that's expensive, and then they've got to, they're supposed to be paying themselves on payroll, and it's a lot more bureaucratic red tape than they needed to at that time. It's okay, create your LLC, right? And then run it as a sole proprietorship until you really get your feet underneath you.
Yeah.
You're gonna need if you make, let's say, $20,000 and you're working 40 hours a week, the IRS is going to say, well, you earned that. That was, you don't have any other employees. You don't, there's no manufacturing. You're not arbitraging like a manufacturing facility.
They're like, here, take it.
Yeah.
Take the money you earn. Like,
right.
Oh, thank you very much. Now give us 24% of it.
Yeah. 24% plus 15.
Yeah.
No. So, but if you're making something smaller, a smaller amount, it's okay. That reasonable salary is going to eat up most of that initial profit anyway, because you are working several hours a week and stuff like that. People may disagree with me, but that's kind of the concept that I've applied in my practice. And, the main thing too is if you go, let's say it goes up to about $75,000, but you're putting in 20 hours a week, right? And maybe you have another job, another W-2 job. So this is kind of a part-time gig, right? But you have employees, or you have like some sort of manufacturing system that's doing a lot more work than you are.
Yeah.
Right? It could be reasonable for you to pay yourself a $25,000 salary as a part-time worker, right? And then the other $50,000 could come to you as, basically
distributions.
Well, no, got to be careful with that term because that's different. But the rest of that income would be considered, unearned in a sense, unearned income, right?
Mm-hmm. That's your investment. That's your
investment part. Right. So, think of it this way. Let's say you invest in a 3D printer, and then you got that 3D printer going on 24/7, but you're only putting in 4 hours a week.
Yeah.
Right. So, and you have another job, then, it's you could pay yourself $50 an hour and you're still not going to, it's not going to be a very big salary, but it could be reasonable. Right. So it's when you're working 80 hours a week and you're making the equivalent of a salary that, if you were to be a CFO of a hospital or something like that, and you should be making 75 to 100,000 or more. That's when the IRS goes, wait a minute, you can't pay yourself 25,000. You're working 80 hours a week. You're paying yourself less than minimum wage now. That's where they're going to have a problem with the reasonable salary.
So you go, it's none of your business, okay?
Yeah.
I'm an American.
Yeah.
No, but you're right.
And I will say this, the really scary part of dealing with the IRS is this is the one situation that you're not innocent until proven guilty. You have to prove you're innocent. They come in with the assumption that, hey, if you don't have proof, we're on the winning side here by default.
Gosh.
Yeah. So, again, a lot of people, they don't keep receipts. So if, or they think a credit card statement is enough. But if you really get a real stickler auditor on your tail, they could potentially say, this isn't substantial. This won't substantiate the expense and throw it out. Right. So
what can I ask a question? Because I'm guilty of that. I know. I mean, a lot of people are, right?
Yeah, who isn't?
Why does that? Because why does that not suffice?
It may suffice just fine. I think it's going to be, if you're audited, it's a case by case.
Because I got news for you, Devin. I got credit card statements are coming to you this year in my tax. I've got some receipts. But why does that not suffice? I mean, to me, it makes sense these days. All the technology we have, it literally says this statement right there. I was at Home Depot. I was at whatever, bought it for this business, the date, everything.
Yeah, I think the easiest way would be like an Amazon, right? Amazon Business, or just say an Amazon. Like if you have an Amazon,
it's all electronic.
Right. So you get an Amazon code. Now, the nice thing about Amazon, and this is great, and this is something I'd recommend, is it keeps all of your purchase history.
Yeah.
Right. So you can go in and show all of those receipts are there. They don't fade. They don't disintegrate. Yeah. So that's nice to have. And so if you get audited, you can go into Amazon and pull that up. Hey, I bought a desk for my office, or I bought an office chair, a computer.
Cleaning supplies.
Absolutely. But if you go to Home Depot and you don't have, you throw away that receipt. Sure, it says Home Depot on your credit card, right? But the IRS is going to go, well, how do I know you didn't buy a fire pit or a grill for your home, right? How do I know that's not a grill or a pergola that you put in your backyard that's not right, that you can't write off, right? And instead of, you could have spent thousands of dollars on cleaning supplies at Home Depot.
It was the lumber that I used to build my office this year.
Yeah.
IRS.
Okay, so hey, listen, if you have the receipts and you can show the office that you've constructed, that's fine.
I sold it.
Right. You are guilty till proven innocent. So again, you can take it to court, but it's going to be very expensive to negotiate, right? So keep that in mind.
It's not like a ticket where you hope the cop doesn't show up and then the case gets dropped. I mean, these guys, they're be showing up.
If they show up at your door, they're gonna. I want to caveat that, like, there are different levels, right? They'll send you a letter and just say, hey, we want substantiation for a specific line item. And then you give them the receipts for that specific line item and they go about their own way. Well, that happens a lot, like with charity on a personal tax return. You say, hey, I gave the church, $20,000. They might go, well, that's very generous of you, but we don't believe you. And that's what's so nice about when the church gives you that year-end statement.
Yeah.
And so that letter, basically exam that they're giving you is, you just fax them a copy of that statement and then you're good to go. Yeah. Right. So, and they'll be like, oh, okay. Yeah. You paid the church $20,000. Great. Here's your refund, or here's, we're done with this. We're not going to go. It's when they're actually like an in-person audit where they're looking at every single line item, where they're really scrutinizing your income tax return. That's when it gets scary. And that's when they're going to really want that substantiation. So I recommend to everybody, I know it's a pain, but keep the receipts.
Yeah.
Again, electronic receipts, Best Buy does, if you have a Best Buy account, they keep track of all your purchases.
I mean, Home Depot does too.
Exactly.
I mean, because I told you, I've done my personal taxes, not the business yet, but like all of my home expenses from Home Depot. You go right. I type my email in at Home Depot. They send me every time I swipe my card. Do you want a email receipt? I try to do it every year because I'm not gonna keep the receipts, to be honest with you. And my wife's all worried about the, what was I saying? The carcinogens that are inside the receipts these days and all this stuff. So
no, doing everything digital has been. I try to do that with everything, like all my subscriptions and all that stuff.
Yeah, because those thermal receipts were fade. But
Yeah.
It will,
if
man.
you can keep it on a backup
Yep.
card, you can keep it on something that's digital. It's nice as long as that media doesn't dissolve. But that's a different podcast.
So what are some of the top things that you see that sets off maybe red flags for the IRS, especially with new businesses? Like what can set off an audit?
A lot of the IRS really looks at what's called listed property. So that would be cars, boats. Like, hey, I bought myself this
A lot of that down here.
$100,000 boat, and I've had
I put my
that.
business name on it. And
Yeah,
we're
they
good.
put their business name on it, and then the IRS goes, yeah, but you used it 99% for personal use. Maybe you took it on a boat parade and showed off your name once, so you could write off 1% of the boat, not 100%.
But that's up to them to decide that.
No, that's up to us to make a reasonable call on that. But if you get audited, they can override what you decide.
They can say no.
There was
1%.
a realtor.
Yeah.
There was a
Wow.
realtor down in Miami and Biscayne, off Biscayne.
Right.
Bought a yacht, tried to write it off, and the IRS was like, "Absolutely not. You're on this 99% of the time. It looks like you're out here to have a good time," and had a great tax guy just like you, a great CPA, and they were able to prove that this guy shows his clients what Miami
Right.
is like from the water.
Right.
Showing them all the high rises that are for sale, showing them all that. That's how he shows.
See, that's a perfect example.
That's how it shows
wow.
real
But,
estate.
yeah, exactly. I actually am familiar with that. But he actually had a business purpose
Yeah.
for that vehicle. Just like it's perfectly fine. You could get a Cadillac Escalade as a realtor, and you're showing your clients around in that Cadillac Escalade. It's when you, let's say, work from home in your manufacturing business, right? Or let's say you're an internet, you drop ship, right? So
Yeah.
there's no travel for you, right?
Yeah.
Everything is just
Conference.
Yeah, that'd be one. But let's say, how often do you drive to a conference? That's great. I love the way you're thinking, by the way.
I'm trying to think outside the box.
That's perfect. I mean, that's exactly. So,
I'm the guy that tries
Yeah.
to find the loopholes.
so you would be able to
Absolutely.
take the mileage going to the conference or write off a portion of the car that you took to the conference. Now, let's say you just had this Cadillac Escalade, you only let's say when the IRS comes or you get audited and the mileage on that Escalade is 300 miles for the whole year. Yeah, I went to Orlando for one conference and I brought it back and it stayed in the garage the rest of the time. I never touched it. I never picked my kids up from school in it. We never went to dinner in it. Sure. That's a possibility. You'd probably be fine.
Yeah.
Because the odometer, let's assume you're not messing with the odometer. Assuming
driving
the odometer,
backwards home.
yeah, exactly. It's
Doing
just
the Ferris Bueller.
Exactly. Assuming you're not, the odometer is correct. That's a pretty, okay, that's fine. It doesn't make much business sense to own an Escalade to make one trip to a conference, but yeah, that's fine. It's when you mix the business and the personal together. The IRS says you can still write off a portion of the Escalade, right? You can still write off a portion of your vehicle, but you can only write off the portion of the vehicle that was used for business purposes.
It's kind of like the same thing with rent too, isn't it? Like if you have like a home office, like you can like kind of take a percentage of like the square feet of like what you're
home office rules,
using.
right? I don't want to wade into the home office rules because that is a whole other
Every
tactic.
year I keep going. I'm like,
But cell phones,
I do have
Right.
a home office.
yeah. When you're a minister, there's a gotcha there. But I
Yeah.
know. But the home office there is, again, oh man, don't
Talking to
drag
you. You know
Don't-
who you are out there.
Bring me back in. We'll
Can't have a home
whole
office and
podcast.
be a minister.
We'll be exactly. You can actually.
You can't.
We can have a whole home office podcast.
Talking to you.
episode.
Gotcha.
But I really, that's a tangent that we could spend an hour on, right? So I don't want to wade into those waters because there's
Yeah.
too many caveats.
No, there is.
The home office is a very loaded question
Yeah.
when it comes to the IRS. So just want to, we'll put a pin in that. But to I think what you're saying is like, let's say for a cell phone, right? If your cell phone service, you use it 80% for business and 20% personal, and you can show that,
Mhm.
then yes, 80% of that cell phone, the cost of the cell phone, the service, that's all can be written off,
Mhm.
right? And so the IRS is going to, they even give you some safe harbors, right? They're going to give you some, hey, I think it's around 75% of cell phones. Like they're just going to say, listen, it's probably going to be about 75%. If you're in that 75% range, then they're not going to bat an eye, right? But if you write off 100% of your cell phone and you don't have another form of communication, that's where they're going to be scratching their head. Like, for example, I keep a cell phone where office calls get forwarded to me, and it's a completely separate cell phone from my personal, right? That is 100% write-off because I only use that for business purposes. There's never a call I make that's personal on that particular cell phone, right?
Not one.
Not that I no, because I have my other cell phone in my pocket at all times, and I hate using the other phone. Right, they don't have my contacts in it. So, but I still write off a portion of my personal cell phone because you call me on my personal. I still write off a portion.
Sorry,
you bug him all the time.
Half of your minutes go to me.
Right.
On that.
But when
he should be thanking you for the write-off.
I'm sorry.
I'm
helping you, man. I'm making you money. I'm making you money.
But there's the vehicle one is a good one because when you write off a vehicle, they actually ask you questions on the tax return. Do you have another vehicle at home? Right? And if you say no, and you write off 100% of that vehicle, you could buy. I know where you're.
I plead the fifth.
No. I have a bicycle.
Right. I walk everywhere.
Find other mode of transportation.
Right. Like, I use a moped only for personal reasons. Yeah, exactly. But the problem is the IRS is you're going to get looked at, right? That's a red flag. If you say, if you don't have any other vehicle and you're writing off 100% of the one vehicle you own, you got to show them the pogo stick and hope they believe you or take it to court. You might as well, by the time you get to tax court, you should have just bought a different vehicle. So, if it's perfectly reasonable to, have a vehicle and maybe it's 50% business, 50% personal. One thing they're going to want no matter what is mileage logs. And it's really easy to kind of track. There's a lot of apps that allow you to keep track of your mileage. I see a lot of people get lazy and, keep track of it. If you give me miles, I'm going to take your word for it. But if you don't have the backup for it, it's going to get thrown out.
So let me stop you right there. Let me ask you about this. Let's get on the topic of trips. Okay. We either fly or we rent vehicles when we go on trips.
Right.
I never use my personal vehicle for trips.
Okay.
So, one of my businesses is my dad's part owner in.
Okay.
So I go to North Carolina a lot because we have property up there. I rent a vehicle when I go up there. We talk about business a lot when I'm up there. Is the whole trip a write-off? And can I use every time I do business and want to rent a vehicle, can I write it off as well?
So we're wading into a little bit of gray area, and that's going to happen a lot with these kind of questions. But I would say, let's say your father is an officer and owner in the business, and you want to have an annual meeting, or you need to have a strategy meeting, or you want to, check on what he's ever doing quarterly. That's fine, right? You rent a vehicle, you drive up there, you guys have the business meeting, right? And the substantial.
We call it a retreat.
Be careful with that one.
I'm just saying that's a forensic. I don't do that, but I'm just saying.
I was gonna say you're
this guy that I'm talking about calls it a retreat. No, I'm just kidding.
So because you're wading into now entertainment, right? Entertainment cost is not tax deductible, right?
Right.
It's funny because you can take clients to a basketball game, and you can deduct half of the hot dogs you bought for them. Mm-hmm. That's a 50% meals. I almost messed it up because it used to be meals and entertainment. It used to be you could take a client to a basketball game and write off half of the whole thing. Mm-hmm. And that changed in I believe it was 2012 that changed.
Obama era.
Yeah, it was that big TICJA bill, I believe. No, I'm sorry. I messed that one up. That was 2016 was TICJA. But yes, there was when they did the Obamacare, they threw out the entertainment part. No, actually, TICJA. That was TICJA that got rid of it. They basically, it was a sacrificial lamb in 2018. When they passed that bill, they had so many other carve outs. They had to give something back to make the numbers work. And so they said no more entertainment and no more unreimbursed employee expenses. So I'm catching myself there, but yeah, that I believe it was the Tax Jobs and Tax Cuts and Jobs Act where that went away. So with the Tax Cuts and Jobs Act, it became where you could only write off half the hot dogs. You couldn't write off the basketball game.
Oh, gotcha.
Son of
It's
a
just
gun.
meals.
Right.
Better eat a lot of hot dogs.
Gosh. Well, Devin, this has been, I mean, you've taken me to school here.
I need to go back and listen in like 0.5 times.
I've been thinking about I've been thinking about this. Let me ask you a couple more questions and then we'll wrap it up. And
Sure.
then, I was talking to you about this before. People need to hear this stuff. A lot of entrepreneurs, they lose out on thousands of dollars because they make the wrong mistakes. They don't have the right, tax professional, CPA that's helping them navigate their business and their tax strategies and expenses and things of that nature. So I think you're honestly, I call you a guardian angel for me and my business, man. I'm grateful for what you do. So, I will say that you've seen thousands of businesses over the years. I'm sure you've seen some comical things.
Yes.
Sad
things?
Let's say, what is the most comical or a few things that are funny that you've seen people try to write off that haven't either gotten written off or you're like, I can't believe that thing got approved.
I think and this might be a little crass, but I had a mentor, a CPA, who's passed away since then, but he was on Ted Turner's accounting team. And there was a deal, I think this was in the 80s. And so it was a deal that was being made with Japan or like a Japanese conglomerate, right? And they went to a gentleman's club. I'm going to try to keep this G-rated, right? They went to a gentleman's club.
A lady of the night.
Well, not that, but there may have been some various states of undress, right? So, and they ran up a massive bill that the company tried to write off, and the IRS came in and was like, "No way, you're not going to write off this evening. There's no way we're going to let you deduct this." And they argued that
it's a lot of dollar bills, man.
They argued that the deal would not have gone through had they not been able to have that meeting.
There you go.
With with whoever they were meeting with.
Yeah.
And they got it approved. They were able to get the deduction. So I think that's the funniest. I think the saddest tax mistake, and this was just because someone didn't go to a CPA.
Hey guys, sorry to stop the episode. This is Aiden here. Due to some unexpected technical difficulties, the audio experience for the remainder of this show may sound a little different than originally intended. We appreciate your understanding as we continue with this episode. Thank you guys so much for listening. Now enjoy the rest of the show.
And they moved a property into it was a spouse, right? And it was doing estate planning, and they moved a property that appreciated a tremendous amount, right? I think they bought it for $1 million and it was worth $8 million.
Wow.
Okay. And
didn't do a 1031 exchange on them. Well, that's the problem. They had to, because when they wouldn't have needed to,
they put it in a trust, a irrevocable trust, a permanent trust, not a living trust, right? So when you gift something, your cost basis, that $1 million cost basis goes into, moves with the gift.
Right.
Right. If you inherit property, you get what's called a stepped up basis. So let's say you own, I don't know, let's go back to Coca-Cola stock.
Yeah.
Let's say you've owned Coca-Cola stock all your life, right? You paid $100 for the stock and it's worth $1 million now. Okay. You leave that $1 million worth of Coca-Cola stock to your son, he could sell that day and not pay a single dime in income tax because he got the stepped up basis. Okay, so you just eliminated almost $1 million worth of income tax, or not income tax on $1 million worth of income, because he inherited it. Now, let's say you gifted, and I see parents do this all of the time because they don't want to do the estate planning, so they
They gift their homes, they gift their stocks to the kids before they pass away, right? That's a gift. Cost basis transfers with the gift. You do not get a stepped up basis. So they transferred this $8 million property into basically a irrevocable trust, which now permanently locks that cost basis into as $1 million. If they had waited, and when the family member that owned that property passed away, they had waited for when he passed away. He did relatively shortly after he made the gift to the trust of the property, right? They could have sold that property. They wouldn't have needed to 1031 exchange it. They could have sold that property and taken $8 million and it would be free and clear for them. Yeah. So under, a lot of people at the end of life, and I see this happen all the time of houses, primary residence, they'll say, it'll just be easier for me to quit claim deed the house over to you. We don't have to worry about going to probate, stuff like that. Be careful. If you have a lot of appreciation in that home, and a lot of older folks do, that's where that's a huge tax mistake I see all of the time.
Yeah.
Yeah.
Man. Yeah, I'm going to end on this one right now. That's a lot of money to lose out on, man.
That one made everybody sick to their stomach.
Yeah, no kidding.
I saw that happen personally, and I was just, it's.
The reason Aiden and we started this podcast is obviously to have pros on here like yourself to come and help other people out, to give them information that they don't necessarily know that can help them, have a better life, have a better business, create something for their family, to pass down, to generations. And so what is, if you could give every entrepreneur one brutally honest piece of advice about taxes, especially someone that's new, what is the one last piece of advice that you would give them?
Well, before we end, I just want to make sure anything that I said, talk to your CPA about that.
Or put a disclaimer.
Yeah, I appreciate that, because there's caveats to everything, right? So this isn't what we're talking about. Is education. It's not necessarily tax advice, right? Okay. So with that being said, I think the brutal honesty is if you're making. If you're going to start to make a lot of money, you're going to have to pay some tax. It's just until the law changes, until we can get to a post-scarcity world, there's going to be some tax you're going to have to pay. Unfortunately, there are scenarios where, I think the bigger guns, you don't pay taxes. And I can, if you have it back, I can talk about that.
Yeah.
But for most entrepreneurs that are getting started, when they start, it's the middle class that always gets hit the worst, right? It's going to be very difficult for you to get your tax bill down to zero, especially when you're making good money, right? And so you might have to just live with that for a little while.
Yeah.
Unless you're Elon Musk and Jeff Bezos, which I don't know how much in taxes they've ever had to pay. Right? It's the middle class. It's us, the people in the middle, that are going to get smacked the worst. But if you can make peace with, hey, listen, I'm making a lot of money, I'm going to have to pay some tax on it, you will be a lot happier in life, right? Because you're not going to be fretting over every dime come knock on my door either and all at me. Yeah, exactly. You're going to be able to sleep at night because you were compliant. You could be aggressive with your tax deductions, right? You can make your arguments that, hey, this was a legitimate business write-off, and but if you're so close to that red line, it's going to be tough to sleep at night because you're going, I can make an argument, but I probably will lose that argument and it's going to cost me. And if you're there, some people love that risk and some people can sleep at night like babies. I'm not that person, right? So I want to be as aggressive as I feel is reasonable, that I can justify, actual deductible expenses, right? Or these deductions, or some of these aren't deductions. Some of these are just straight up, tax loopholes or tax carve outs that, you're allowed to take, right? I don't want to just say the only way to reduce your taxes is through deductions. There's a lot of other strategies to do that. But, I think for entrepreneurs, the first thing we focus on is what can we write off, right? What expenses can we write off? So yeah, that's kind of what I said.
No, I think it's great, man. We really appreciate you coming out of the show because,
knowledge is power. And I think a lot of people, they always keep saying, you hear a lot of either lower middle class or a lot of the, I don't want to say poor people, but like a lot of people tend to complain and go, well, everybody needs to pay their fair share. It's like, I don't think that those people are educated enough to know that there are actual loopholes out there. Like, you don't have to. Am I right? Like,
I mean, so it really comes down to the law, right? So if you're complying to the letter of the law may not be fair, right? And so that's up to Congress to change the law, right? But it's a lot harder to make the law fair than it seems on the face of it, right?
Yeah.
A lot of people are saying, well, we should do mark to market. Well, that opens up that's going to hurt a lot more people than it will help in the form of extra tax revenue. In my opinion, that is an opinion. There's, if you try to make the law fair, it usually backfires. But I'm just saying there are loopholes that can, if you comply with the law right, you do it right, you're paying a lot less in taxes than some people who aren't using that legal, I'm using loophole as loosely, but that carve out or that legal instrument that allows you not to have to pay tax. I can give you an example, but I don't know if we got enough time for it.
We'll save it for next time. Yeah, I just think we'd love to have you as a standing guest, even if you can't make it in person. We'll have to set something up, maybe quarterly. We could do a quarterly check-in whenever you get time. I know you're a busy guy, but we'll figure it out just because I know that people are going to want more info on this. Okay. But really appreciate you coming on the show, Devin. He's a good friend. He's helped me a lot over the years, even though I bug him or he's like, don't start another LLC without me. Really blessed to know you, man. And I pray that the Lord continues to bless your business and just, continue to make you fruitful in what you do and prosperous, man, because you're helping a lot of people. And so with that, I just want to say thank you so much for watching. You want to take us out?
Yeah. So if you guys want to connect with Devin, we'll have a thing on our website to do that, pitchesandniches.com. And then make sure to follow us on all of our social medias. We're on Instagram, TikTok, basically everything. And then make sure to follow and subscribe for more videos. We drop one every Monday. We drop a podcast. And then, so we'll see you guys next time.
Yeah. And then you're interested, I'll say that if you're interested in coming on the show, or you know someone who's a professional like Devin, or someone's got a startup or a pitch that they want to pitch out to the listeners, come on our website, pitchesandniches.com, fill out a form, or you can email us at pitchesandniches or contact@pitchesandniches.com. Thanks for watching, everybody.